Hey there, it's Dave Keller with Market Misbehavior. Today we're going to talk about using the Relative Strength Index, or RSI, to understand multiple time frames. Now, when I say multiple time frames in this context, I'm really talking about just the relationship of price over time, or the evolution of price over time. I think a lot of times investors and traders tend to oversimplify. You just think, is this going up or going down? Is it bullish or bearish? Should I be long or short? But what you have to remember is there's always a time frame either directly assigned or implied by a position that you're taking. When you buy a stock or an ETF, are you buying it thinking about the next minute, the next day, the next week, the next decade? How you'd answer that time question should inform your analytical process. And what I mean to rephrase is the tools and the techniques that you use today to make those trades should match the time frame of where you're trying to go, your investment horizon. With that in mind, I think the RSI is an indicator that's sometimes used incorrectly. I was taught that overbought is bad because things have gone too high, and oversold is bad. Oversold is good because it's gone too low too quickly. And betting on mean reversion was the general approach that I was taught: buy low, sell high, and using RSI and tools like that, oscillators, to try to quantify it. In reality, there's a lot more context to be applied, and work by Connie Brown and Andrew Cardwell and others really, for me, built on Wells Wilder's original work creating the RSI. And gave some really interesting techniques, particularly what we're going to talk about in a moment, which is the phases of the RSI. Both of those books, all the books I just mentioned, by the way, in the notes in the description below. So check them out if you want more information. Before we get to the charts and all the information, here's one thing I wanted to let you know about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model, or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha, or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year, and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, here we're looking at the chart of Alphabet, ticker GOOGL. Now we're looking at this chart, and I have the price, the 50 and 200-day moving averages in the top. In the bottom, I have the RSI, the Relative Strength Index. And again, this is an indicator created by Wells Wilder in the 1970s as a way to measure price momentum, really for commodities. But now we apply RSI to a lot of different things. We're using a 14-day RSI, which is kind of the standard setting. This is what Wells Wilder originally came up with, and most kind of keep it to that setting. And I've not found any meaningful reasons why to change Wells's original work to create this indicator. Now, here's the issue. If you look at Alphabet, right, for the last 2 years, you can see that the first maybe half of this chart in a downtrend phase. The right half of the chart, really from 2022 to 2023, more of an accumulation phase, or an uptrend. Now, here's the thing. If we're looking for the RSI to be overbought, it doesn't happen this whole time. So if I'm looking for times to sell or to short Alphabet on the way down, I'm not really getting any of those signals. I am getting buy signals, according to that original definition, when the RSI goes below 30, but it never really gets above 70. So I don't really have any good ways to initiate any sort of downside position. On the other hand, when we rally, the RSI never really gets down to the oversold condition, never really gets down to 30. So if I'm looking for opportunities to buy weakness, I'm not getting that from this indicator. I want to introduce, again, an approach that Connie Brown popularized in her book, Technical Analysis for the Trading Professional, where she talked about phases of RSI. Her conjecture, which I would 100% agree with, is in a bearish phase, or what I would call a distribution phase, an area like I've shaded in red here. the entire of the range of the RSI sort of bumps down a little bit. So we become oversold, or we often become oversold on the downswings. When we have that counter trend rally back to the upside like we did here in March of last year, in August of last year, the RSI doesn't get all the way up to 70. It usually tops up around 60, meaning the whole range, instead of 30 being oversold and 70 being overbought's now down around 60 in a bearish phase. When the market changes to more of an accumulation phase, an uptrend phase like you see in 2023, I've shaded that area in green. Look how the entire range of the RSI actually bumps up. So when we have a rally, an impulse move, meaning a move in the direction of the larger trend, the RSI becomes overbought. When we pull back, the RSI never gets down to 30, usually bottoms out around 40. So recognizing that the phase has shifted, this larger time frame, this is where, when I talk about multiple time frames, this is what I'm talking about. On the bigger picture, we can see a downtrend phase and an uptrend phase. The RSI not only helps us identify some tactical points, right? Where to buy the dips in an uptrend or sell the rips in a downtrend, right? Sell those short-term bounces. Just the range of the RSI and where it's in tells us a lot about the broader conditions. So when you have a chart in a downtrend like you had with Alphabet in 2022, one of the things I would be looking for is on one of these rallies, instead of the RSI stalling out around 60, which it did on all of these sort of bear market rallies, finally you had a rally where the RSI broke above there and got all the way up to 70. So what that means is short term, maybe a good pullback opportunity because we're overbought. But long term, the fact that we even got up there might suggest that the range of the RSI is moving up. And once we confirm that with a pullback where the RSI hits 40, this sort of confirms that we've gone from a downtrend of lower lows and lower highs to an uptrend of higher highs and higher lows. So an indicator like RSI, I love to pay attention to it, particularly the phases that we're in, and thinking about when I know something's going down. What I'm looking for is a rally where the RSI actually becomes overbought. That's short-term negative because it tells us we're overextended, but long-term is actually more of a constructive pattern because it tells us that enough momentum is actually pushing the price to an overbought condition on that impulse move. In an uptrend phase, what I would be looking for is a pullback where the RSI doesn't stop at 40, but actually continues lower. And when the RSI starts breaking down below 40 and gets down to 30 or lower on the downswings, that's what suggests to me we might be more in a distribution phase, and those short-term tactical movements are really part of a larger bearish price structure. So applying that mentality to where we're seeing Alphabet right now, and a lot of other growth stocks have a pretty similar configuration for now. You see the price has been making higher highs and higher lows. Recently here at the end of August, Alphabet made a new high for the year. But what's most encouraging to me is not only the price action, but also the fact that the RSI is in a bullish phase. As long as we keep becoming overbought on rallies, and as long as the RSI doesn't get below 40 on any pullbacks, I'm more inclined to think a chart like this is in an accumulation phase as opposed to a distribution phase. That's how we can use RSI, the Relative Strength Index, to understand phases, understand the trends overall, and relate the short-term price swings to the larger-term trends. I think that multiple time frame mentality is so important for investors, so you don't get caught up in the noise of the short term, but recognize how that makes the larger-term pictures really play out. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. I'll talk to you again soon.